Due diligence talks previously, when you look at multifamily apartments, the old rule of thumb for any type of light value add, you'd see $5,000 of renovations per unit. And you may see $100 rent growth from there, which if you just do the math, $1,200 a year divided by, say, like a 5 cap would be like a 24% ROI on renovation dollars. Now, what we're seeing now in this market is the rents are flat. Last couple of years have been actually sometimes negative in some places, but we're starting to see tractions, and probably next year, especially as the new inventory burns off, it'll probably go in the more positive range and probably inflate as inflation comes back, like we all anticipate. But right now, you're seeing these are obviously inflated construction costs, but it's like you're trying to revive a dead body with more and more amps on the heartbeat defibrillator. So even if you were to put in 15 grand, you're only seeing like a $50 to $100 a month bump. And then when you do the math, that comes out to a 4 to 8% ROI. Definitely not looking to do it. At one time, we had the idea of if you're putting in $5,000, you want to see that half of that come back in the first year. But you're seeing how dispiriting that is today. That's just the kind of the state of the economy today. But in reality, right now is like the best time to enter deals because everything's so much cheaper than it is today, and things will just inflate from here on out. But when things are, and this is the reminder, like in 2021, when things were rocking, you could do nothing. You could spend no dollars to it and see this rent bump up, and you get an infinite return on your money. But that is a clear sign that the market is overheated and you're buying at the peak. The big picture is you're at the bottom of the market cycle right now in terms of pricing. It's the unsophisticated investors that see, oh, rents are skyrocketing. Yeah, because you're at the end of the market cycle and you're right before the crash. This all is in hindsight, right? But hopefully that just when things get too hot, do that double take check. And when things seem like it's fearful, as Warren Buffett says, this is the kind of the time to possibly enter. So other points here, renovated units often lease slower than the classics because right now people are having a tough time. So they're not paying for the nicer units as they once did the last 5 years. So that's why the premium assets are harder to realize these rent bumps too. Like I said, I think the screening is if we can't get the double-digit ROI in renovation dollars after lease up, we pass. And I think there is some carryover to if you have a single family home. To do anything in a single family home would probably cost 20 grand. You're probably going to just be able to bump the rents up by $50 or $100, and that's not going to cut it. That's probably in the mid single digits. But if you could pay 20 grand to open up a section, add a wet bar, or call it a 5th bedroom, for example, that may give you the lift to bump the rents up by 250, 300. Then it might make sense. So that's the rule of thumb on that. So here's just a chart in case you had those situations come up. And people are like, let me renovate the bathroom. The bathroom gets you $100 a month in rent bump. No, then don't do it. Put the money elsewhere. Your ROI is going to be better elsewhere. We buy the finish line, not the slide. Okay, so this is the same thing, but in more of that formula form. So if a fixer was a 4.5 cap, but only works to 6% yield on cost with risk and with the time and risk associated with that, right? Because whenever you go to construction, there's risk. It could go higher as a cost overrun, change order, or there could be some risk in the time that you're doing that work in terms of macroeconomics, economy. You'd rather just buy a cleaner asset, like a higher end, maybe that means like a B+ asset. Doesn't necessarily mean like a luxury asset, class A. So the interesting nuance right now, and this will probably change in certainly 12 to 18 months, is many value add are already priced into the upside. So paying for retail for the post-renovation story isn't a smart thing to do. So an example here, so if you buy at $200,000 a unit, and I would probably say most class Bs are selling for this price, which is crazy because 10 years ago, you'd be buying class B at $120,000 per unit. But anyway, you're buying the income stream. So if the NOI is $9,000, that you're going in cap is 4.5%. Typically, the caps on apartments is 4 to 6 these days. So if you spend $15,000 at CapEx, your all-in basis is 215, and then you do the math here, and you can compare numbers this way. I think how this translates to passive investors, when you look at a deal, try and break it down per unit. What are these guys buying this unit as? Like, people will send us deals a lot, and the first thing we talk, oh, would they buy per unit? Oh, 230. Oh, interesting. It helps you understand it on a per unit basis, and then you guys may not have the rules of thumb in your head, but it helps you think like, all right, so what's the CapEx budget? What's the business plan on this investment? Very rarely it's nothing, but like sometimes there's a pretty significant renovation, which might be $2 million, for example. Then divide that by, say, 250 units, if it's a large building, and you can break it down and you can get it to fit into this. We're trying to fit it into something that we see again and again. One thing I forgot to mention, so these days, $7,000 of renovation per unit is probably more on that lighter side. This is new flooring, appliances, paint job, but that's about it. Now you're getting into more medium rehabs down on this side here. So this is something you never take from a syndicator, right? Is a heavy value add? Is a medium value add? It's all over the place. It's like never trust them if it's class A, B, or C. But this is numerically, as a passive investor, you need to know where does the business plan fall on the spectrum. And the best quick and dirty way is, what the heck is the CapEx budget for the entire thing divided by the number of units, and then you can fit it into this chart here. There's some rules of thumb here, but for me, I would just fit it into this chart. And if it's not hitting 15 or 20%, then it just doesn't make sense to do the lift. Now you have a method. You open up the deck. What's the purchase price? How many units divided? Get the unit price per unit. And if it's Dallas, I mean, class A minus, something that's built 2005, 2020, like this would be class A. It's not brand spanking new, because then you'd be in the 250, 300,000 and better. But I think class A is like 250. Your class Bs are your like 160 to 220. And then your class Cs, which I think when Richard started investing, those class Cs were like in the 50.
40, 50.
40, 50, yeah. I know the cheapest property we bought was class C in Alabama. This is Alabama, so a little bit cheaper, in the 30s per unit. But yeah, in Dallas, let's just call it used to be in the 50s. Today, I think you're lucky to get anything under 100. So if Richard brought me something that's 85,000, built 1965, I'd probably say, Richard, it's probably infested with rats. But then he's going to, no, I drove this place. It's not bad. And it's 93% occupied. All right, now we're cooking. Now we got a deal. Well, I think that's a real quick and dirty way of, as a passive investor, like, what is the price per unit these suckers are getting this thing under contract for? And I fit it into that. And if you guys ever had questions, just put it into the Discord. I'm always trying to stay up on this. Obviously, it's not rocket science, but it generally moves up, right? So if you stay out of the game for 18 months, you may have to add 10, 20 grand onto price per unit. But that's exactly why you buy real estate, because it tends to appreciate over time. The next part is get the renovation budget. And this can be tricky. There's interior improvements and external improvements. Sometimes it's like the external improvements are big ticket items, such as playground equipment, the showroom floor of the leasing office. That could be $500,000 right there, right? That can skew the numbers. I would just take the entire CapEx budget, interior units and exterior, and just put it all in one and use your CapEx per unit. I don't really see the need right away to just get greedy in terms of interior improvements per unit, if that